Welcome to this edition of Wall Street Unfiltered. Today, we're going to address some major trends that are important and I think will impact the future. First, we're going to talk to David Winters and Liz Kornauer, both of Wintergreen funds. There's been a lot of talk about Winters and his activism with Coke, and we're going to get into Coke for sure. David, in my opinion, is benchmarking what is a larger trend in the hedge fund industry. And it's a trend, incidentally, that was identified and popularized by author Michael Lewis. My conversation with the Wintergreen people is interesting, but when you listen, like I said, focus on that larger trend in the hedge fund industry because it's going to help you understand how future developments are going to fit into the picture. And in my opinion, the information that matters is information that can help people wrap their minds around what's potentially going to happen in the future, what's a probability, what's not a probability based on logic. And really, once you start to mold this information, then you can start to see what's really important, which I also think is what's the most interesting aspects and the most interesting stories in financial services. After David and Liz, we're going to discuss another major trend that's taking place, and it's just starting to go public. There's been talk behind the scenes, and there's still a lot of talk behind the scenes, and there's still a lot of details that haven't become public yet. But as firms such as Point72 and Bridgewater make public their algorithmic trading divisions, or I should say investing divisions, hedge fund managers on the East Coast tend to get a little sensitive about the differentiation between those terms. But anyway, what I'm going to do is we're going to look at this trend for hedge funds to get into an algorithmic overlay. And I'm going to bring in one of the oldest systematic fund managers who uses traditional managed futures signals to trade individual stocks, which actually there's a unique twist to this. Traditional equity fund managers using an algorithmic overlay to enhance their performance, in particular with regards to correlations. And I want to consider it from the ultimate goal, what I consider to be the ultimate goal, the holy grail, the truly non-correlated investment product. So let's start to take a look at how certain hedge funds are moving in that direction, because again, that's, in my opinion, where the future is. Just like Wayne Gretzky, let's go to where the puck's going to be. That's the show today, and let's get right into it. I want to set up this David Winters interview so that the overall trend and the bigger picture comes into play. You know, it's been close to a year since Michael Lewis came out with his book Flash Boys, and he wrote a piece in Vanity Fair that essentially recapped what has happened in roughly a year since Flash Boys pretty much exploded onto the mainstream. Now, as a sidebar, there are some very important things he said, but I tend to think the most important things were what he didn't say after a year and what he didn't recap as to what has happened. Many of the true insights Lewis delivers in that book wasn't just about high-frequency trading. I'm going to suggest that you can look over the past 5 years and connect some pretty important dots. And Lewis says his story is not about high-frequency trading. But that's been the main debate. His story is about individuals standing up for what they consider is right, and they're standing up to an establishment that some say has lost its way and is in need of a direction change. And what's interesting is Lewis says it's not the Goliaths of this industry who are making the change. It's sort of the mid-level, the upper mid-level people who, or average kind of people who are doing extraordinary things. They're on the inside, so they know what's going on. They know how things work. And they know that we've sort of reached a point. There's been, in my opinion, based on my inside knowledge of MF Global, there's been a descending trend for investor protections. And I think certain people are standing up. They're saying, no, this trend has got to end. It's time for mean reversion. It's time for a counter trend. And I see that trend happening. I see other people in the media who ignore it. I see some people in the media who talk against it. So I guess you're kind of talking against investor protections when you do that. But when we look at David Winters and we listen to David Winters and this interview, I want you to consider sort of the higher level aspect, because here's David Winters' story. He wasn't what I would consider a well-known fund manager before Coke. He wasn't a household name, let's put it that way. And when he first arrived upon the scenes, started making noise about the comp at Coca-Cola, they were proposing a compensation plan. I think people initially didn't get, the headline attention. I remember my editor, Jacob, put some information in front of me, said, what do you think? Looked it over, investigated, talked to some people. People were saying to me, hey, he's bringing up a valid point. He's just David Winters, and he doesn't command the same media presence and the same attention that a Bill Ackman would gather. So, Value Walking, we started writing articles. Other media were writing articles about what Winters was saying, and we tried to get to the inside of it. And at the end of the day, this sort of middle hedge fund manager, you can say that based on his assets under management. Very sharp guy, sharp team. I've met some of the people on his team, sharp people, but kind of in the middle of the hedge fund range, accurately questioned this compensation package for a company where the stock wasn't doing too well. And his barbs may have been sharp at times, but they were ultimately proven to be true, and even Warren Buffett, who sits on the Coca-Cola board, eventually agreed with Winters to a certain extent. What Winters exposed is dissatisfaction with sort of this establishment way of operating on corporate boards. And if you look at polls of institutional investors, they are agreeing with activist hedge fund managers more and more. This establishment way of this clubby kind of environment between the board of directors, and, it's a clubby sort of mentality, and Winters is questioning it. And he's the individual, he's the Brad Katsuyama of this sort of realm. There are other activist hedge fund managers who have long been questioning how boards operate and saying that they're taking advantage of investors. I think the big trend is institutional investors are starting to stand up. They're starting to say, no, the institutional investor needs to be protected. They should be at the top of the food chain. That's my personal belief. And I see people standing up and saying that the established way of doing things, or the established way of hiding things and them not being discussed or put in the open, isn't working, because it's led to a system that benefits a few and it doesn't benefit everyone in the financial services industry. So I think that's a trend. I think that's also a trend you can compare, take it outside of the financial services industry, and you can see that trend in society. So I know that's a lot to sort of put into a package, but I want to bring in David Winters from Wintergreen Fund Management, and also Liz Kornhauer, Chief Operating Officer, and they have some interesting things to say. What I want to start with, David, is sort of crystallize for me that moment in time that you realized something had to be done at Coke, because you have a background as a Midwesterner. You're a value investor. You're not an activist. So kind of paint that picture in a couple sentences, if you could.
We read the Coke proxy. We were shocked. We couldn't believe it. And Liz Kornhauer is my business partner. We talked about it. And Liz said, as a fiduciary, we have to do something. This is nobody had ever seen anything this outrageous, and we felt that the right thing to do to protect our investors was to object.
It's interesting because by and large, you're, in my opinion, sort of leading a trend. In 2011, when MF Global hit, and this is more my background than your background, institutional investors didn't feel protected, particularly that bond offering. And what I start to see is institutional investors are standing up. And there are polls that show that institutional investors are increasingly supporting the activities of activist investors. Where do you see yourself sort of in a larger trend, and where is this headed?
We want to behave in an ethical manner, and ethics, we believe, are one of the key things. We know performance goes up and down. We think that this is the beginning of a very important trend in the U.S. and around the world, for people really to take their fiduciary responsibilities extremely seriously.
Okay, wait a minute. Breaking news. ethics is coming back into style in the financial services industry. Where do you see your efforts with Coke heading?
Well, we feel that we've made substantial progress with Coca-Cola. We've just had a first glimpse of the proxy, and they're it's only minimal, but they're starting to address their problems and acknowledge that they have big problems. We're hopeful that Coca-Cola can be fixed. We think it's a great American company that's been woefully mismanaged. And, frankly, we think that the way they've behaved is shockingly unethical. And, for us who believe that the investor is king or queen and that their money has to be protected. And so we think ultimately Coca-Cola will get cleaned up, and then it will be run for all shareholders.
Shockingly unethical is a big statement. Can you back that up in a couple sentences?
Well, Coca-Cola produced a proxy, which the 2014 equity plan, where they represented that the new plan was identical, Muhtar Kent said this, to the 2008 plan, and it's not. And it's dramatically different. It was a huge increase. And also, they have something that we call the secret bonus shares, which were not in the proxy, which can be issued in an unlimited amount with no criteria. We've never seen anything like this.
And the basics of their equity plan was that it was performance-based. So the heart of the matter that they presented to shareholders was a performance-based equity plan. It happened to be about 150% of the 08 plan to cover two-thirds the time as they presented it last year. But they described it as performance-based, and the secret bonus shares were not in the proxy. They're only in the equity plan itself, and they can be limited or issued in unlimited amount without any criteria at all.
It seems to me, David and Liz, you guys are doing the work of the board of directors. Shouldn't the board of directors be uncovering these issues and addressing them?
The board should recognize that they work for the shareholders. That's their ultimate boss. And I think that it's a cozy atmosphere at Coke.
Well, it's interesting, and now I think you guys are touching on a key issue, is the cozy atmosphere. All board of directors, it's a very social accomplishment. And as a matter of fact, a lot of the activist investors, what they have realized is that part of their influence is by attacking the board members on a social basis and coming at their reputations, which David and Liz, you guys have not done. You guys have stuck by and large to the facts. Your barbs have been very sharp, but you've been by and large fact-based in your assessment. Let's talk about 3G for a minute. You guys identified early on that 3G was a potential suitor for Coke. And then Value Walk wrote about the inside story. And then I think sometimes when you bring out the inside story or you talk about things that might happen in the future, it sort of diminishes the impact, and they don't end up happening. And that's a positive thing when you talk about market volatility or issues that can dampen the overall market environment. But with Coke, we already talked about 3G. What do you think the odds that 3G comes into play in potentially purchasing Coke, or do you think it will be turned around?
Well, first of all, we don't know. But we think that the rumors, the articles about 3G, and then Buffett's categorical denial, we think that pretty much put an end to the 3G possibilities of them coming in. We've heard over and over again more recently that the rumors were real, but, I can't prove it.
And the reports in the Brazilian press, yeah.
Yeah. So we think they were there. They were looking. Remember, Coke has refused to comment. Buffett's refused to talk about any, arrangements he had with 3G. We're hopeful that Coca-Cola will be turned around through increasing pressure from the shareholders, and we think that this document they came out with, the proxy today, doesn't resolve the fundamental problems of bad management at Coke.
And Muhtar Kent today declined to take his bonus. It's interesting. The stock, as of January 3rd, 2014, was at $40.36. Today, I looked at it just before we got on this call. The stock stood at $40.36, down 10 cents after over a year. How does someone get a bonus with that kind of stock performance?
It's hard to explain or imagine how they justified it. The proxy this year, I believe, says that the company's performance was something like 66th percentile of what it is that they expected. And the named executives had their personal performance at over 100%. I don't know how they justify that or really measure it. Muhtar declined his bonus, but his overall comp is up.
Yeah, I mean,
18.1.
and depending on how you look at it, it's up 20%. So it doesn't look good. And I think that we firmly believe change is coming to Coca-Cola, that it's an undervalued consumer products company, and that it's beloved, but that the issues haven't been addressed. And the other thing that we really think is that there has to be a succession plan in place to replace Muhtar, because he's a personable guy, but he's not done a good job while he's been there.
David Winters, Wintergreen, Liz, you guys have been at the forefront of a fascinating trend. Coca-Cola is coming down. 2015 could be an interesting year, potentially a year of change. And if something does occur, I think that clearly the impetus for that needs to be directed at Wintergreen, because you guys have really brought this issue to the fore. Thanks for joining us today.
Thank you, Mark.
The next interview is with a managed futures CTA, and managed futures, in my opinion, has been sort of a stepchild in the hedge fund world. It always seems to be held to a different performance standard than equity hedge funds, because particularly the performance during crisis for managed futures CTAs has been nothing short of stunning. And the fund category is coming off 4 of its worst years in history. And the length of those drawdowns on a continuous basis has been a little challenging, but the depth of the drawdown hasn't been that bad. Now, managed futures market environments switched, some say around June, July of 2014, and we're anticipating additional volatility. So the asset class it was the top performing asset class on HSBC's fund list, as I've noted a number of times. So there's a turnaround. But what's really interesting is how traditional equity hedge funds are starting to look at managed futures. Some of what some equity fund managers are doing is they're looking at a managed futures overlay in their portfolio. And they realize that if they design it properly, there's a modeling that shows that the negative performance can be relatively minor if the proper risk controls are in place. And then where you really want it is when the markets go south. If a market goes south on a persistent basis, managed futures typically is going to hold up like a champ. Okay, so not to get off on a different tangent, but what I'm trying to do is set up the next interview with managed futures CTA Jerry Parker of Chesapeake Capital. And let me also set this up from an entertaining method so you can understand the industry a little. And I'm going to use Eddie Murphy and Dan Aykroyd in the movie Trading Places, so you understand a little about Jerry's background and sort of the turtle background, which I think is an important point of history, and it's also entertaining. Jerry Parker is known as an original turtle trader. It's a group of trend followers that were particularly important in shaping the history of the managed futures industry in the 1980s. And also included names like John Henry. John Henry went on to apply his algorithmic trading skills to the Boston Red Sox, and they eventually won a world championship as a result. There are a number of other traders. I'm not going to mention them all. And the strategy has developed since then. Some people have embraced the developments. Other people stick to the same moving average cross, where the entry algorithm is the same by and large as the exit algorithm. And the dean of many of these early trend followers, the sort of master who taught the skill, was a man named Richard Dennis and his partner Bill Eckhart. These are the people that influenced and trained Jerry Parker. It's been said that Dennis and Eckhart were the original story for trading places. They were the Duke brothers that had an actual bet where one said trading could be taught and the discipline could be learned, and the other said trading was instinctual to certain people. Parker is one of these original students, and he's had a winding road in trend following, and he has been at the forefront of executing single stocks in a managed futures strategy, which is reasonably rare. In this interview, we're going to talk about the differences of trading individual stocks relative to commodity indices or interest rates or currencies. And then we're also going to talk about the indexation of the managed futures industry, which is sort of a trend. I hear it occasionally. I just spoke to someone in the brokerage world who was telling me about it. And, there's a debate there, and I think that should be put forward because I think it helps people understand what's going on inside the industry. So without further ado, let me get right into the interview with Jerry. Welcome to the show, Jerry.
Thanks, Mark. Thanks for having me.
My pleasure. Let's start out by talking about trend following in individual stocks. And I have seen this concept grow probably since about 2011, I would say. And interestingly enough, it sort of timed with the stimulus that kind of came into the market and really lifted a lot of the equity markets in some decent trends. And what trend followers that trade in individual stocks tell me is they've seen some very smooth trends in stocks, and then sometimes around earnings you might get some volatility that can go either way for you. But overall, they've seen some very good trends in stocks, particularly over the last couple years. Can you talk to us about your individual trading methodology for trend following with stocks?
Sure. We use the same methods and systems and parameters for the single stock futures as we do for the other markets, the currencies, commodities, and interest rates. And as you can kind of anecdotally realize that there's been great trends. Maybe some of the best or only trends have been in the single names in the stock market in general. And from a trend following point of view, where one traditionally will make most of the money from 10% of the trades and participate in sort of an outlier, large moves, single stocks provide that, and of course, almost by definition, an index, being an average, would not provide the type of outlier moves that a single stock might. So it's perfect for trend followers, great diversification. Maybe you can combine indices also. It's just like I was taught in 1983. You can put your hand over top of the name of the market, and you're supposed to trade it as if you don't know anything about it or what it is. That's how we do it.
Trend following mantra. You're one of the old turtles.
Exactly. Trade all the markets the same way, long and short, and hang on for the trend, and sort of no optimization for each market or any situation. I think that the research might show that it's a little bit better to be longer term in the stocks than maybe some of the other markets, and the shorts are not profitable.
Yeah, see, that's one of the big differences you're probably going to see in stocks with commodities. The long-short ratio is going to be a little different. Stocks you're going to be on the long side much more than you are on the short side, I would imagine.
And then the shorts are not profitable. We've never found a way to make money in the short single names, but we trade the short indices if there are signals in those. So we're sort of long the single names and short the indices whenever the trends warrant it.
That's interesting. So your short exposure is the broad indice. Your long exposure is in the individual names.
We trade 100 names, and like all good CTAs, we're interested primarily in one thing, and two things, diversification and liquidity. So we trade fixed universe of the S&P 100.
And you trade that primarily through single stock futures at One Chicago. Do you call in to get special bid-ask pricing, or are you trading, taking the electronic market?
We call market makers the block trades, the 5 line of the block trade. And so you can get a market maker to do the cash in the trade, and do the trade in the cash market, and sort of like a currency EFP.
Right. Let's talk about indexation for a minute. So I had a conversation the other day, I think I mentioned it to you, where someone involved in the managed futures index industry said to me, Mark, the way this industry is going, it's towards indexation, meaning that people are going to get their investment exposure to managed futures through an index. What do you think about that?
Well, I think it's difficult to see it going in a pure index way. I believe that what will inevitably happen will be index-like fees, unfortunately, or low fees for CTAs. But currently, when CTAs create index products alongside of an alpha, more of an alpha product, they on purpose create the index, make sure the index is inferior. So I don't think that's going to last. I believe that as competition increases, CTAs will always want to put forth their best efforts and the best methodologies that they have and just charge lower fees. So commodity trading, futures trading, trend following will probably continue to be a commodity type product, no pun intended, and probably settling around 100 basis points. Sort of like active management in equities would be where I would sort of see it going. And certainly as more CTAs struggle to raise assets, and it looks like that the liquid alternative mutual funds, CTA mutual funds, are sort of the wave of the future. I would definitely anticipate that, like all good mutual fund managers, those fees are going to go lower. And I think we'll look a lot like traditional equity managers, just trading currencies, commodities, interest rates, and stocks.
Well, it's interesting that you say that, because when you start to look at a number of the different algorithms, as I do, I look at probably hundreds of different funds, you start to appreciate the different nuance that is put into risk management. Certain people have different triggers. One might be a volatility trigger. Another might be still a simple moving average cross trigger. The nuance and the sophistication of all the different strategies, I don't believe can be incorporated into one index or one formula. As a funny sidebar, I remember S&P used to claim that they had a managed futures index, and it was really just a simple moving average cross formula. And I made the argument to a couple regulators that you can't claim managed futures is represented by a single algorithm. And eventually that name changed. And so I think it's going to be interesting to see where we go. And I think you're right. I have yet to be impressed by any managed futures index. I've been much more impressed by the individual managers and the diligence they take.
Exactly. I mean, why choose? Why choose one or two or 50? The genesis of indexing is lower fees. That's what prompts people to put out index products. I'm just saying that the index and the alpha are not going to live together. It's going to sort of all become sort of alpha, but yet priced like an index. So everyone wins. You can choose a half a dozen CTAs. Just your fees will be 50 basis points or 1 and 0 or whatever, but there's no reason to make those choices, and I don't think what we do really lends itself to one algorithm or one system in the same way that the S&P index does.
Interesting. Jerry Parker, one of the original turtles, perhaps the longest running trader of single stocks in the managed futures universe. Thanks for joining us today.
Thank you, Mark. Enjoyed it.
So did I.